Hey everybody, I hope you all are doing well and welcome back to Michael's Matters. Now that the holidays are long over and the world is getting back to business, tax season is just around the corner. It also means that if you had health coverage over the last year, you may need to submit one of the triplets of forms of the 1095 family. So that could be the 1095A or the 1095B or maybe even the 1095C. The largest of the group of those three, though, is probably going to be the 1095A for folks who got their health insurance coverage through a health exchange. And this one's also very important because it could mean the difference of thousands, if not tens of thousands of dollars if it's not right. So today I'm going to do a walkthrough and explanation of the 1095A form and what to do if it's not correct. Now, before we get to it, if you like these videos, if you find them interesting, if you find them helpful, or at least if you find them useful, please don't forget to like and subscribe because it really does help the channel to grow. And we are so thankful for that, but also because you get updates when our newest and most informative videos become available. Oh, now let's get down to the video. So let's start off by talking about what is the 1095 form and why it's important and why it could be the reason someone has to pay back a lot or even their full tax return if it's incorrect. First, the 1095 form is used to indicate a person had health coverage. So that could be health coverage through a health exchange or through their work or directly through an insurance company or a government program. Any number of one of those are going to be shown on a 1095. And depending on where in the United States that you live, for some, it may be necessary to submit these forms with your taxes just to verify that you actually had health coverage or potentially face a penalty. Here in California specifically, there is what is called an individual mandate that requires everybody to have health coverage or potentially pay a penalty. On the federal level, the penalty still exists, but it got changed to $0. So it is essentially the individual mandate equivalent of the sound of one hand clapping. Now, depending on where somebody got their health insurance in the previous year, it'll determine which of the 1095 forms that they're going to use. And it's possible to have one of each of these forms, or maybe multiples of these forms, or just one of these forms. It can be any number of combination depending on how many times you changed your health coverage and where you got them from throughout the year. To that end, the 1095A is the one that is probably the reason that someone is watching this, because it is the form that is used when filing taxes, along with a 1040 form to fill out an 8962 form, which is the form that the IRS uses to figure out if you got a monthly premium assistance on your exchange health plan, and if that amount was correct based on your income and household size primarily. Now, this 1095A is generated by the health exchange that you were in. So if you're in a state like California, that would be Covered California, or in other states, they have the federal exchange, healthcare.gov, or even sometimes I think like some of the states have their own individual state ones as well, like Nevada or maybe Massachusetts. And those usually start to get sent out as of January, so you can do your taxes. Next up is the 1095B, which is a version of form that looks a little bit different, and we'll talk about that probably in another video, but the long and the short of it is the 1095B form is a form for somebody who got their health coverage typically through a government program specifically. So not a health exchange, not Covered California or in California, but something like Medicaid or Medi-Cal or the VA or even Medicare is what would generate a 1095B form. Now, this form is not usually needed when you file your taxes because the government program who is doing the health insuring usually will send that information directly over to the IRS. But sometimes, it doesn't get sent or it gets lost, etc. And so you can request that form, the 1095B, from the organization that provided the coverage, so you can show that coverage and which month you had it. The last version of the triplets for the 1095 form is the 1095C, which is another variation that is provided to a person when they have health coverage through an employer-sponsored insurance plan. And on this form, essentially what it shows is which month a person had coverage, if they were offered coverage and they denied it, and which coverage they had. So that is 1095C for employer-sponsored health coverage. But the main focus for this video today is going to be the 1095A. So let's get into the nitty gritty of the 1095A form, because again, this is the one that most people are probably watching for because it is the most financially consequential. And also, perhaps somebody got a letter from the IRS requesting an 8962 or a 1095A form on their taxes. So here we go. Now, the 1095A form is a relatively simple form because part one, it is the basic information for a person. I have one here that I have completely slightly made up, so this information is not correct or specific or even real in any real way, but the numbers do add up. But I made this one up here, and for part 1, you can see box 1 is going to be the state. So in this case, that is California. Number 2 is the number that is assigned by the marketplace, so that's something that will be just automatically on there. Box 3 is the name of the insurance company that provided the coverage. Now remember, through the exchanges, the insurance companies, whether that is Molina in this case, or Blue Shield or Humana, or really whoever you have who's ever on that line, those are the people who actually provide the health insurance, because the exchanges do not. They actually just help people pay for the plan, but the actual insurance is done by the actual private health insurance company, and that'll be in that box. Box 4 is going to be the name of the person, so John Johnson. And box 5 is the socials. Box 6 is the date of birth. Box 7 would be for a spouse if there is one, but in this case, John Johnson doesn't have a spouse. 8 would be their information as well. And 10 is when the policy start date starts, and 11 is when it ended, and 12 is the street address, followed by 13, 14, and 15. So all that is pretty straightforward. Part 2 is going to have who is covered, which again is pretty straightforward. But let's get to part 3 because this is where there's a lot of confusion. Part 3 is the part that indicates what is on record as far as dollars and cents about how much financial assistance or APTC a person got in the previous year for their health insurance plan. These numbers are based off of 4 things overall that are put onto the health insurance application at the beginning of the year, and that's how they determine what that APTC. Those 4 things are age, income, household size, and location for each of the members of the people who are on the plan. These 4 things do determine the cost of the plan, as well as how much financial assistance a person is going to be eligible for. One of the big stumbling blocks for this is that in December of the previous year, or maybe in January, folks are being asked to put in an income and a household size for that year to come on their health application, which means that they have to make an estimate about how much money they are going to make by 12/31 of the end of that same year. Now, I don't know about you, but knowing exactly how much money you're going to make by the end of the year is a pretty tall order for even the most meticulous of income calculators. But you do have to do it to do the application and to get the APTC and to not get an insurance plan that's crazy expensive. So when you put in that income on the application with the other 4 criteria, it ends up spitting out how much money you have to pay every month. 95% of the people who get coverage through a health exchange, they are going to get some monthly financial assistance to help pay for their plan so that it is quote unquote affordable. And again, that is the Advanced Premium Tax Credit, or APTC. The APTC is the magic behind the exchange that makes plans affordable, but it's also sort of kind of volatile for households throughout the year that experience changes in one of those 4 criteria. Now, usually the 2 biggest culprits are the income changes and the household size changes, but sometimes the location change and age does change, but it changes at a predictable rate. So that one's not too big of a problem. The APTC is calculated using something called the federal poverty level. And if we look at the chart here for the FPLs, you can see at 100% of the FPL, if you are below 100% of the FPL, then the federal government says that you are below the poverty level. And if you are above 100%, then you are above the poverty level. So you're not impoverished according to the government. Now, as your income moves up, depending on your household size, also moves up is your FPL level. So the federal poverty level percentage goes up. When this happens, it means that as your FPL goes up, you qualify for less and less APTC, because since you have higher income, then you need less APTC to help bring down the cost of your health insurance plan. That's the logic. So with that kind of cleared up here, it's important to realize that if changes happen to your household during the year that could change or have an effect on your FPL, but it was not updated with the exchange through your exchange, it means that the APTC that you got throughout the year may be incorrect and also might need to get adjusted, which is done on your taxes to equal out to whatever the correct amount is. So for example, you sold a car and now you made $10,000 more than you thought you were going to make in the beginning of the year. And let's say you start at 138% of the FPL for a single person, and now at that, with an additional $10,000 or thereabouts, you're at 200% of the FPL. So it also means that for somebody whose income was at 138 or $20,121, but now you made $29,160 because you sold your car. Some of that APTC that you got throughout the year, you're going to have to pay back because each month you got essentially too much financial assistance, and that amount is what they take out of your tax return. So they're not really taking any money from you that shouldn't have been there. It's just that it feels like it because maybe you didn't realize you got too much APTC. One of the other big ones that hits folks a lot by surprise is that their income stayed the same. It didn't change throughout the year, but let's say, for example, they had a child who was 18 who turned 19 or 21 or 26 or whatever, and now they're no longer on there. Or they could have got divorced and someone else, two people now become one person, but the income stays at $39,440 a year, or 200% of that FPL. If that child isn't going to be on the taxes for that year because they aged out, but the income stays the same, it means for one person, if that income stayed the same at $39,440, instead of being at 200% of the FPL, now they're in that 266% range, which would again mean that they got too much APTC throughout the year, and that APTC was dialed in at 200% FPL, not 266, but actually, minus that child, they move farther up the FPL level, up to that 266 income, and that is another situation where now at the end of the year, they're gonna have to pay some of that APTC back on their tax. And really, actually, both these situations would mean a pretty serious chunk of change to have to be paid back. So back to the 1095A form, in part 3, you can see that the first column, there are the months of the year. Then in column A, it indicates how much was the full unsubsidized premium for the insurance plan, whichever plan someone chose, so before APTC was applied. In the column next to it, in column B, then it shows how much was the second lowest cost silver plan, the SLCSP. I don't know if anyone calls it that, but which is important because it is the anchor plan for the exchanges. But ultimately, even if you choose a gold plan or a platinum plan or a bronze plan, whichever level plan you choose, that second lowest cost silver plan is always going to be exactly the same in that column B, showing how much the cost was for it. Now, lastly, the column C, we can see how much APTC or advanced premium tax credit a person got for each of the months. And in this case, when we look at John's plan, it was $420.57 unsubsidized. So that's how much the actual plan costs, and that's how much the insurance company gets every single month. But John got $166.53 a month from the exchange to bring down his cost to $254.04 a month. So essentially, he's paying $254, the exchange is paying $166, and the insurance company gets $420.57. So that's kind of how that whole mixture works. On line 33, we can see that it shows how much APTC was received throughout the year. That was based, again, on the income and household size of John when he did his insurance application in the previous year, usually in December. So in this specific situation, if John made more money and that was be showing up on his 1040, let's say he made $10,000 and more a year, but he didn't update the exchange, when he does this 1040, it'll show that additional $10,000 worth of income. When that information is put into the form 8962 to figure out if the $1,998 that he received during the year to help pay for his plan was correct, it'll show it was actually too much because he made $10,000 more than he put on the application, which means a portion of that $1,998 he got in advance premium tax credit is going to have to be paid back. Now, inversely, I guess in the same vein, but on the opposite side, is if he made $10,000 less, then the 8962 form would show that even with the $1,998, he paid too much during the year for his health coverage, so it wasn't affordable as a percentage of his income, and he would in fact get additional money back on his taxes. So realistically, by the end of the year, when you really think about it, it is the exact same amount of money, whatever number you put on the application, because however you slice it, they're going to justify it at the end of the year. So if you made more money than you put on the application, you're going to have to pay some money back. If you made less money on your application than what you put on your application, then you're actually going to get additional advanced premium tax credit to bring you kind of whole right to that level to the percentage of your income that the government feels is affordable for you. So when you have to pay money back, though, it just means that there's additional either income or you moved up the FPL from where you were on your application. and you just have to account for that. So overall, the 1095A form is just a way to track how much subsidy somebody received through their health plan throughout the year, and it can be confusing and frustrating or even confounding, especially at the end of the year when the form comes out and the income is different and somebody has to pay that money back. But ultimately, again, it is the same amount. You either pay it during the year every month, or you pay it in at the end of the year in one lump sum, but either way is the same amount. But also sometimes they are not correct. So let's talk a little bit about what to do if this form is not correct. So there is what is called a 1095A dispute form, in which case you can dispute any of the information on your 1095A. If you, for example, had someone who had coverage who was not on there, or vice versa, or you had coverage for months that you, it doesn't say it didn't have months that you had coverage, but you actually had coverage on those months. All that stuff can be disputed on the form. It can even be done, I think, if you call into Covered California or into the exchange, they can do it that way. But just bear in mind that if you do the form, you can also print it off from the website. But if you do the form, make sure you get it in as soon as possible, because it takes quite some time to actually get it done. And then there's also a lot of people who had errors, or at least submitting dispute forms for their errors, so they get real backed up as you get closer to tax season. So if you do get a 1095A and you think it's wrong, want to get that in. Also, if you did not get your 1095A and you need another one sent out to you, there's a couple options. One is you can reach out to someone who works with the exchange. So it could be an agent, it could be a navigator, certified enrollment counselor. Those folks, they can basically print off your 1095A for you. Also, if you call the exchange, they won't print it for you, but they can mail it to you, a copy. Or if you have access to your health exchange account, you can log into that and print it off or download it yourself as well. So those are all great options if you don't get it, or if it's wrong. There are ways to fix it, but as far as fixing it does take some time. All right, so that's it for today's Michael's Matters, and I really hope you enjoyed this video. And if you did, if you found it interesting or helpful, or maybe even at least useful, please don't forget to like and subscribe, because it really does help the channel grow. And again, we are so thankful for that, so thank you. But also because you can get updates when our newest and most informative videos become available. So for Michael's Matters, I'm Michael, hoping that you take care of yourselves, take care of others, and have a happy, healthy